In this week's update, uranium bursts to life. The rally remains sustainable, and what stocks will do very well in coming years. My name's Garry Davis, and as always, this is general advice only. And please remember to like and subscribe to the video. All right, let's start with the usual market perspective. This rally has been making people nervous for most of this year, particularly since we got that rotation from growth stocks back to value stocks. And everyone seems to be wanting to fall over themselves to pick a top in the market. But secular bull markets, which we are in, started in 2013 and probably is going to extend for perhaps another decade at least. Secular bull markets are marked by the sort of resiliency we're seeing that comes from, rather than a big general pullback in the market where all sectors go down together, what we're getting is a sort of a rolling correction, if you like. So varying sectors at different times are having their own little corrections. When you roll it all up into the overall index, you don't tend to see much, which is why the S&P is just edging forward, just day after day, week after week. But what's actually going on under the surface is a correction of sorts. And this is not at all atypical for secular bull markets. So, my really clear message is, don't get drawn into the people that want to try and call a market top all the time. If the opportunity is there, and certainly there are some tremendous trends and some tremendous breakouts in America, if the opportunity is there, then just go with it. Structure it accordingly. If it's a trading situation, then, have your stop loss in an effective place and execute it if it happens and all that sort of thing. But, don't pass up on opportunities just because you're concerned that the rally's not sustainable. Now, we're still continuing to see the aggressive sectors continuing to lead the advance, and we'll see that in the spread charts that I look at every week. The most explosive growth in price, so the really big breakouts that are occurring, and in America there are just dozens and dozens and dozens of large cap stocks that are breaking out in extraordinary fashion, and it's generally because they're producing extraordinary results. We're seeing massive beats against both revenues and earnings. So the explosive price rises we're seeing are being triggered by the real thing. This is real profits and real revenue growth. Now, I'm absolutely convinced that if you're clear about what you're doing, that even for people that that don't like volatile stocks, that are more comfortable in defensive stocks, that you can have part of your portfolio in high volatility stocks that you can do really well out of. And we're seeing, many multiples of hundreds of % gains in a lot of these stocks, both in America and Australia. And you can do it in a way that doesn't, cause you to freak out. You can remain calm through the whole process. You don't have to step aside just because they're high growth and high volatility stocks. There are ways to do it. And I'll have more to say on that. It's all in your game plan. It's just so critical. Now, over the last month or so, I've been outlining the principles for effective portfolio construction that should yield, in the right hands, should yield significantly better results compared to how most people go about it, because most people just don't have a plan. And I'm doing this because I can help traders and investors avoid all the mistakes that I made, not to speak of the umpteen wasted years and the very large sums of money that I wasted in self-teaching myself. I had no mentor, I had no guidance, and it was it was hard going. It was trial and error, and it was time consuming, and it was very expensive. And nowadays, when I'm not looking after my own trading, I'm providing services to members to help them be as good as they can be. So, this is what I do with much of my week, because I'm in a position to make a contribution. So, that's hence why I've been doing what I've been doing over the last month or so, and why I've put together this short course on how to effectively construct and manage a portfolio. So it's a brand new course. There are 5 in-depth training modules. They're in a lot more depth than what you've seen in these weekly videos over the last month, where I really just touched on the concepts, but there's a lot more examples and a lot more detail. It's really my step-by-step process for how to put it together and how to manage it. Now, the missing element for most traders is the lack of a clear game plan. You know, I've been working with people now for nearly 20 years, and hardly anyone has gone to the trouble of putting together a clear game plan that they then stick to. The other aspect about markets these days is that there is just such a mountain of information that it's almost a given that you're going to be overwhelmed by it if you're a relatively new entrant to the market. And it's a very difficult thing to know where to start, how to cut that mountain of information down to just the things that really do make a difference. And as a result, because most people haven't really put this plan together, they tend to make reactive decisions based on emotions. Now, I get the question all the time about stocks or ETFs that are going to be good for the next 5 years or the next 10 years. People want to take the easy way out. That is just to get something, put it together, and then just sit on it for 5 or 10 years. And whilst that might be fine in theory, you can just buy the megatrend ETFs. In reality, it doesn't work very well for nearly anybody, because when the market starts to do sudden things, then it's very hard to stay the journey. It's very easy to get emotional about it and decide to sell and step back. And if you think back to what happened in the COVID crash in February, March of 2020, and just have a think about how you felt about things. Did you remain calm and composed during that period, or did you find it difficult to stick to a game plan? So it's a huge advantage to pre-think our actions. There's just no question about that. We're going to get far more consistent results. We're going to get far more effective results the more that we can pre-think and plan and be prepared for, when the market gets a bit rocky. When the market's just going up week after week, it's easy. That's not what you need to get prepared for. You need to get prepared for the odd time when we get a significant market correction. That's when you really make your money. So what you'll learn in this course is the actionable principles and market realities. I've been summarising them over the last month, so you know what they are if you've been watching this weekend video, but you'll get those in a lot more detail. It's really important to learn how to think strategically and not reactively, and there's a certain amount of that in there as well. It's at least a good starting point. Obviously, how to build and manage the portfolio which is appropriate for you, because there is no one-size-fits-all answer to this. It's a matter of being clear about what you want, who you are, and the sort of results that you're after. You'll gain the skills to buy, the right stocks for you, or as right as they can be, at good times, at good effective times. And generally, that's a bit of a contrarian activity. You generally want to be trying to buy stocks when they're down short term, whereas our human nature tends to have us wanting to try buying stocks when they're up. Now, your investment for the course, it's a one-time payment of $49. We're just keeping it as low as is reasonable. And there is a special discount for members. You'll read about that in your inbox. So the message I want to leave you with before I get back to the main part of the video is that this is an opportunity to take control of your financial future like very, very few people ever do. It's just far too important to leave it to chance. It's really easy just to sort of wing it and think that you'll find a way through, but it's just far too important to do it that way. There is a link to the course in the description of this video. So the market and looking after my members is what I spend my life doing and have been doing for nearly 2 decades. This course is the distillation of what I've learned over that 35 years in total that I've been in the market, and what I find is effective and highly profitable. It's the best start that I can give you. It's not the end point, but it's the best start I can give you, and I really do commend it to you. Now, in addition, you will get complimentary access to Portfolio Analyst for 2 weeks, even if you've already taken the trial. So if you've already done it once, that's okay. You can come back and you can do it for another couple of weeks. And the education and the opportunities and the strategic thinking that's in Portfolio Analyst every week, I think is really, really valuable. So I'll leave it at that. Back to the summary of last week's action in America. So the S&P was up another 0.6 for the week. It's just grinding higher. Friday night we saw a very poor jobs report, and the expectation is that is going to slow down the Fed process of tapering. Now, whether it does or it doesn't, I don't know. It's one data point. Who knows? Next week, next month, we might get a piece of economic data that says something different, and all this is forgotten. So I'm not getting too hopeful about what this actually means. Let's just take the market as it comes. Importantly, the aggressive sectors were still leading. The Nasdaq was actually up on Friday night. The S&P was down. Small caps were down. But the market is still looking very positive. The US dollar eased again, so we've broken a little bit of a support. I must say I'm a bit surprised by this, but it is what it is. The US dollar was down a little bit again, 92.04. The 10-year yield is still sitting around the low 1.3s, and the VIX is still sitting at 16.5. So that was pretty much what we saw last week. All right, let's jump in and look at some charts. So here's the S&P. So you can, going back to my comments at the start, and that's we've got this rolling rotation it's allowing the S&P just to keep grinding higher with only 2 or 3 days down. That's all we're getting, because some other sector that's they might have had a correction 2 weeks ago, and now that one then has a stronger week, and it's just keeping this market very healthy. And I mean, that is just one beautiful trend. It's just it's quite amazing. If we look at the Nasdaq, so you can see new all-time highs, all the moving averages, the 20-day, the 50-day, and the 200-day, all lined up beautifully. The index is above all of them, and the Nasdaq is outperforming the S&P, which is important. That keeps the fund managers' money flows focused on those areas of the market. And, it's just generally a very positive outlook at the moment. This is the Russell 2000 for small caps, so it is lagging on a relative basis to the other sectors, but it's managed to hold this support, and it's almost to the top of that trading band. Now let's look at some of the key spreads. This is a new one that I've been tracking a bit lately, that I've introduced now. So this is the small cap growth stocks. So I think it's I'm not sure of how many stocks are involved in this, but it's obviously many hundreds. But this is the index, the Dow Jones US small cap growth, divided into US small cap value stocks. And you can see that when that ratio is rising, as it did through here, then that means that growth stocks are outperforming value stocks. Now, that stopped being the case in November last year, and we got this very abrupt rotation into value stocks, and so that line fell for some time, but that bottomed out in May, and ever since May, we've been going back up again. So that rotation from growth to value finished, and we're now back to growth leading. And that's where the money flows are, and that's where we should have our attention. There's no point trying to swim against the tide and wave your arms around and say, yeah, but value stocks they're really good value and they really should go up. But we've been saying that for probably the last 5 years. At the end of the day, you really want to go where the money flows are going, because that's where you're going to make the easiest money, just like it's the easiest swimming with the tide. You don't swim against it. This is the chart that I've been showing for quite a long time now. This is Russell 1000 growth, so this will tend to be more large cap stocks versus the value stocks, and very, very similar. We bottomed in May, and the growth stocks have been outperforming. And consumer discretionary versus consumer staples has been a little bit weaker of late, but look, Amazon is the key component to consumer discretionary, and Amazon's result wasn't all that great, or it wasn't what the market expected, and so that's been weighing a bit on the consumer discretionary. But if you start to look at some of the many industry groups within consumer discretionary, particularly areas like footwear, some of them are just going gangbusters. So we've got to take this chart in context. But nevertheless, it's not signalling that we've got a problem with market sentiment. I think that's the key thing about this particular chart. Now, as I said at the start, uranium had an amazing week. I've been talking about uranium for 3 years. Members, I think, have got thoroughly bored about me saying that it's inevitable, it's a no-brainer, etc., etc. Well, I think we're finally now starting to see a real pickup in the uranium sector, and you can just see. So this is a peak since this index URA was in operation, which is 2011. You can see back then it was at $130. Now we're down in the mid-20s. So you can see just how much potential upside there is in the uranium sector. It's a great deal, and I think it's going to continue to unfold because the outlook is very strong for deficits as far as we can see, and there is some new dynamics have come into the market that are going to make those deficits even bigger. So let's zero in a little bit and have a closer look. We had a support and resistance level to get through there. We burst through it back in April, May, June. Then it came back off the boil, came back into the range, which was pretty disappointing. And I was just about to risk slitting stage at this time because it just seemed so inevitable, but it just wasn't happening on the charts. For some reason, it was the sector was being ignored. But you can see we just had an enormous run for the sector last week. I think we're up something like 21% for the week in URA, and you can see the 2 days at the finish where URA just exploded to the upside. So that is undoubtedly the strongest sector and industry group for the week. But look, I can tell you that semiconductors are also looking pretty good as well. Sorry, I didn't have that one queued up. So semiconductor index, you can see we've now broken out of this consolidation zone, mucked around for a little while, but now we're clearly on our way. And September's a pretty good month for semiconductors as well. If you look at the accumulation distribution line, looks very impressive, and it is holding its own against the S&P. We outperformed here. We've been holding ground steady, but I think you'll start to see the semiconductor sector turn up against the S&P and start to outperform. And again, the important thing about that is that it attracts more fund manager money. If semiconductors are outperforming, then fund managers cannot afford not to put more money to work in that sector. It becomes a self-propelling spiral to the upside until it just gets too far ahead of itself, and then you get a correction. But that's how it works. All right, turning to the currencies. Okay, this is the US dollar. So we had a little peep over resistance on the 19th of August. that looked good, looked like a breakout was on, but we've pulled back and we've now formed a lower, we've broken this little support area here the last 2 days, which is a real head scratcher for me. This chart is now hard to read. I guess if we take out this low here, then you've just got to say, well, the US dollar is probably heading back down here again. But I think we're in a zone of uncertainty here at the moment. So you probably don't want to be making too many bets that are currency related at the moment. Now that, of course, has impacted the Australian dollar, and the Australian dollar has gone from looking very, very weak, and we've now burst back into the range and actually broken out above this little high here and finished the week at 74.02. So that's that market. So 74.02. Our index went up 0.5%. The small cap index, as opposed to America, where it's, the small caps are struggling relatively. Most of the action is in the large caps. The small cap index is just absolutely killing it. It really is, and we'll look at that chart. A lot of it is in mining. Obviously in battery materials, stocks are doing incredibly well. Not so much gold stocks at the moment, but a lot of mining stocks are doing extremely well. But there's plenty of strong performers across many other sectors, industrials, biotechs, whatever. But the one thing they've got in common is that they're all high growth, technically driven, disruptor kind of companies. So that's a bit of a hallmark of the Australian market at the moment. So if we look at XSO to start with, so that is the small cap index in Australia, XSO. You can see just had a terrific week. We're now as far above the 50-day moving average as we normally get. So this is a trend of great strength. There's materials. They've definitely struggled the last few weeks as iron ore's come off, and of course all the other toing and froing with BHP. That's had a big impact on that sector. This is the XJO. It's managed which is the ASX 200. So it's managed to hold up pretty well. It's not far off its highs. This is healthcare, so new highs for healthcare. Finance not really doing much, and energy has been struggling as well. All right, let's go now to precious metals. Just that point, there's about 15 or 20 uranium stocks listed on the Australian market. It was double-digit gains in nearly every single uranium stock last week. So if you wanted to make money in the Australian market last week, the best place to be was in uranium and lithium and nickel and rare earths. That's where the money's being made in Australia at the moment. Now, as a result of the US dollar falling, gold went up by $10, but given the amount of move in the currency, $10 was not really enough, and so to my mind, gold was actually underperforming the currency. It should have done a little better than that. Now, silver firmed up. It did a little better than gold on a relative basis, and we'll look at that ratio chart. But when we go to GDX, GDXJ, the downside case has definitely been weakened. There's no question about that. But look, it's not over. One of the dynamics of the market is that the computer algorithms, try to run the stops. They run a little bit past points of support and resistance just to try and pick off the stop losses that might be there. So precious metal stocks, they are continuing to underperform the metals, and I think that's why I'm still open to the concept that we could get a meaningful decline in the sector, but that bearish case has been blunted to a fair degree in my view. So let's look at those charts. So I'll just have a quick look at Bitcoin. So there is Bitcoin finished the week at just on 50,000. So gone pretty much sideways for the last couple of weeks. All right, this gold on a weekly basis, not a big move, and I would have thought the way that the US dollar has gone that it was probably entitled to be a bit higher. There's the daily chart. So we still haven't overcome this little level here. Now I think if and when gold does go above that level, which is at 1834, then you've got to turn bullish again. But for now, we haven't violated that upside yet. If you look at silver, silver had a very strong move on Friday. So it'll be interesting to see what happens next week. If we look at some of the spreads around gold and silver, so this is gold miners versus the gold ETF. You can see we're still in relative downtrend. And this is gold versus silver. So it's turned back down again, which means that silver is gaining ground relative to gold. Now look at GDXJ this week, because to me this is the most meaningful chart. It was the one that had broken down below, really important support, picking up highs and lows all the way through here. Now we've managed to rally back above what was a support line. Should have become resistance. Friday we jumped over the top of it. But look, it did close well off its highs, and it failed to close above the 50-day moving average. So it's just sort of hanging on by the skin of its teeth at the moment. I wouldn't write off a decline, but I can't feel at all confident about that at this point in time. Okay, turning to other commodities. Copper was steady, about $4.24. Nickel did move up though, with the currency effect, to $8.80. And really nothing has shifted there in the outlook. I've got nothing more to add. Crude oil was a little bit higher to 68.6, but not a lot of movement there. So there's the spot copper chart, pretty much sideways. Nickel continuing to work its way higher. So final thoughts. I posed the question at the start, what stocks are going to do exceptionally well in coming years? And in this video, each week I try to give perspective and insight into where the money's going, and and things like what level of overall exposures are important. When it comes down to individual stocks, though, this is what I do in Portfolio Analyst and the Insiders Club. It's what membership offers, and there's a great many opportunities in those services. But look, it's so much more about game plan and clear strategic thinking and perspective on where the money flows are going than about stock tips. So if you're someone that gets a bunch of stock tips and thinks you've got some sort of prize or something valuable, then I can tell you that it just isn't worth very much. Stock tips on their own just aren't worth very much, in my opinion. It's about having a really good game plan. It's about consistent execution of that game plan. That's really what matters. And that's where you need to be placing your focus. Portfolio Analyst last week, we looked at what is proving to be the most reliable trade setup in America at the moment. It's in the large caps, and there is a certain chart pattern that is proving to be extremely reliable and extremely profitable. We also looked at battery materials stocks in detail in Portfolio Analyst last week, and we also looked at the best time to buy ETFs. So that was an interesting question to address. So that's it for this week. Anyone that wants more information, there's an email address where you can contact me, and more information on our website. Please take note of the portfolio construction video. I think for a handful of dollars, you're going to get a great deal of value from that. So that's it for this week. Cheers.